Greetings, and welcome to KBRA's newest Sovereigns podcast. I'm Joan Feldon-Vidra, and I look after sovereign ratings for KBRA. Today I'll be sharing some of KBRA's views on emerging markets in light of the many different impulses that threaten to impair credit quality. For some background, we do recall that COVID-19 brought about an unprecedented buildup in sovereign debt across the globe. For emerging markets, recall that this was very much enabled by the massive stimulus in advanced economies, and that stimulus helped emerging markets do the exact same thing. And as a result, the world was largely operating in a very synchronous policy environment. That, along with backstops from the international community, helped alleviate a lot of stress. Shortly after, then came the vaccinations ahead of expectations, plus pent-up demand, thanks to generally healthier household balance sheets in many corners of the world. And this pent-up demand coincided with supply chains that were very much still impaired. So what happened? Inflation, and emerging markets with less tolerance for inflation were much quicker to the trigger to hike rates. Their advanced peers have trailed way behind, many only just embarking or about to embark on tightening cycles. And this inflation was only exacerbated by China's zero COVID policy and the war in Ukraine. So this leaves many emerging markets in a position that they hiked early on while still having to hike more because of added inflationary impulses. This situation, is serving to significantly dampen growth. Indeed, revised forecasts for emerging market growth are looking at 3 to 4% over the next few years, not exactly enough to correct their enlarging debt burdens. And risk seems to tilt to the downside, especially if hard landings are not avoided in advanced economies, i.e., namely the U.S. and Europe. So now with the world once again moving in sync, with tightening financial conditions across the board in general, risks are quite elevated. So in the current environment, inflation is really the key source of risk. But there are also other areas of sovereign risk that we'd like to emphasize. The first is China's slowdown. Now, China is actually one of the only countries in the world, there are very few, that are embarking on stimulative macro policies, although to a large extent that has been greatly offset by its strict lockdowns. Some countries are especially exposed to a slowdown in China because of their trade dependency, and those countries will feel the pain more than others. Quite a few emerging markets have China as their main trading partner. And beyond the near term, KBRA is also concerned that China is just now on a lower growth trajectory after its debt-induced binge post-global financial crisis. So very recently, in fact, just now, China has begun to somewhat loosen its lockdowns, but more could await on the horizon as more COVID variants come and go. So the medium and long-term risks from China remain elevated in our view, and the short-term risks are also quite elevated. But the situation is not strictly negative for emerging markets. Of course, it's more complicated than just their trade relationships with China in the context of a China slowdown. For example, if you're a country that has a large dependence on China for exports, but are also a commodity producer, you could, and very likely, you could be enjoying very much the boon of high energy prices or high commodity prices. While this may be favorable to that sovereign in the short term, we do admonish, again, over the longer term, what goes up is likely to go down, and that could be disruptive for emerging markets heavily dependent on commodities. The second risk that we'd like to highlight relates to growing autarkic tendencies that we're seeing across the world, and very much related, food prices. Quite a few countries, prompted by food security issues, are banning exports, thereby reducing, in many cases, years and years of progress toward economic liberalization for trade. And this is a difficult situation. The protectionism started with Indonesia and palm oil, then India and wheat. Again, reversing these measures might be politically quite challenging. There's always stickiness in one direction. Giving people money is a lot easier than taking it away. And that export ban is like a tax credit to people. Undoing it is like introducing a new tax. Not so easy. And we do worry there could be long-term stickiness issues at the higher level for food prices, related not only to climate change and all those other factors that influence it, but also the reduction in fertilizer availability, given that Russia is such an important supplier on the international market. already this season, or at least over the past few months for sure, the current crop seasons are affected by the reduction in fertilizer availability. If those levels of exports don't re-equilibrate soon, next year could be a problem for food security as well. So in other words, this may not just be a short-term problem. And food prices are key to watch for emerging market inflation. Well, to a large extent, the risks for emerging markets are externally generated, right? Even though they have elevated debt burdens, which they accumulated. But how countries manage these risks is also important. We have in many countries elections, an election season in the context of a rise in populism. That's also adding to uncertainties in the policy environment across several jurisdictions. That's not just for emerging markets, of course. It's also for advanced economies, but for emerging markets, it tends to be more significant. In terms of managing risks going forward, we have to look out for countries that opt to take advantage of the boom of commodity prices to, for example, to embark on structural reforms that could improve their longer-term outlooks. For example, a commodity producer enjoying windfall gains in terms of trade, well, does it take the space that's been made available to embark on structural change, for example, restructuring ailing state-owned enterprises or pension reform? Taking advantage of nearshoring opportunities could be another way that there's a structural change that could help them over the longer term. That nearshoring opportunities could present themselves more readily now because of rising geopolitical risks. And of course, all that we've learned about the rigidity of supply chains. Again, it's the policy environment and the behavior in an economy that can actually end up being the main determinant of credit risk. One more point we should emphasize is Russia's looming default. We did not notably include that as part of the what we see as the main triggers of elevated risk in emerging markets. We believe that the markets will be decoupled from that credit event. Beyond these observations, so it's important to note that the fundamentals in many emerging markets are strengthened and make many emerging markets more resilient to these new found risks. First, many countries have amassed reserves that allow them to weather the disruption, at least over the short term, on a temporary basis. Second, multilateral development banks play a role here, and they have quite a bit of firepower to draw on to help countries bridge the distress. Third, markets have largely sold off a lot of EM exposures, meaning that EMs are less vulnerable to sudden stops than they were in the past. And fourth, many countries now have a flexible exchange rate, giving them a lot more flexibility to manage shocks, and have also reduced their reliance on foreign currency borrowing. In general, debt structures are improved. Less foreign currency debt, more domestic debt, less exchange rate risk, longer weighted average maturities, reduced inflation-linked debt, broader investor bases, to name a few. So to wrap this podcast up, risk has risen across the emerging market sovereign asset class, but there are offsetting factors. Whatever the case, there is a lot to monitor. That's all for now. This concludes our Sovereigns podcast. Thank you for listening, and always feel free to reach out to our team with questions or feedback.